Welcome back to The Explainer, unpacking the incredible journey of a man widely known as the Warren Buffett of India. I'm talking, of course, about Rakesh Jhunjhunwala. Imagine taking just a handful of cash and spinning it into an empire so massive it literally alters the landscape of a nation's financial market. Well, that's exactly what he did. He reached a staggering net worth of $5.5 billion. That's roughly 10,000 crores. Today, we're going to reverse engineer his playbook. Okay, let's dive into the agenda. We're going to start with the making of a billionaire, trace his first big risks, explore how he mastered market momentum, look at his ultimate test of patience, and finally, distill all of this into the Big Bull's playbook. Section 1. The making of a billionaire. From middle-class beginnings to a 10,000 crore fortune. So Rakesh Jhunjhunwala definitely didn't start out with a silver spoon. He grew up in Mumbai, the son of an income tax officer, basically absorbing the rhythm of the markets just from listening to his father's living room chats. But that brings us to the ultimate question, doesn't it? How exactly do you bridge the gap between casual living room chats and a $5.5 billion empire? Well, the reality of his starting point might actually shock you. He started with literally just 5,000 rupees. No joke. When he told his dad he wanted to make a career in the stock market, his father supported the unconventional choice, but with one massive caveat. He absolutely refused to give Rakesh any money to start, and he explicitly told him not to ask his friends for money either. So right out of the gate, Rakesh was forced to become a self-made hustler. Now, what's really interesting about his initial capital is how creative he had to get. 5,000 rupees just wasn't going to cut it for making big moves. So he went to his brother, who was a chartered accountant, and managed to secure a loan of 1.5 lakh rupees. But the real game changer, that came from a client. Rakesh pitched an investor, pointing out that banks were only offering an 8% return, and he boldly promised them an 18% return. The client went for it and gave him 10 lakh rupees. Just like that, the big bull had his war chest. Section 2. Taking the first big risks. The Tata Tea and Sesa Goa triumphs. To really appreciate these early career milestones, you kind of have to transport yourself back to the mid-1980s. The BSE Sensex, which, sits in the tens of thousands today, was hovering at just 150 points. Between 1985 and 1989, he started making these legendary trades in a fledgling market, completely setting the foundation for his massive wealth. His first really significant risk was with Tata Tea. He bought 5,000 shares at 43 rupees a pop. And within just a short period, the price absolutely rocketed to 143 rupees. He sold, locking in a 300% return and a cool 5 lakh profit. This single trade was incredibly validating for him. It proved to himself, and more importantly to the clients he promised that 18% return to, that his instincts were dead on. But honestly, that Tata Tea win was just the warm-up. Next came Sesa Goa. The iron ore industry was struggling, prices were in the basement, and investors were just fleeing. But Jhunjhunwala did his fundamental research. He knew global demand for iron and steel wasn't going anywhere. So he risked almost his entire capital, a staggering 1 crore rupees, buying 4 lakh shares at 28 rupees. And of course, the market eventually caught up to his logic. The stock broke out, and he sold shares as high as the 165 rupee range, pulling in crores in pure profit. Section 3. Mastering market momentum. Contrarian plays and short selling. Jhunjhunwala didn't just understand fundamental analysis. He had this incredible, innate sense of market momentum. He consistently thought differently from the herd. He was the ultimate contrarian. A perfect example of this was the 1989 VP Singh Bridget. The entire market was in a panic, assuming the new government's budget would be super anti-business. Everyone was pulling their money out. But Jhunjhunwala looked at VP Singh's background as a former Minister of Commerce and concluded the budget would actually be business-friendly. He went all in while everyone else panicked. When the budget dropped and his prediction proved true, his net worth surged by 20% in just a month. And he was highly adaptable, too. During the 1992 Harshad Mehta scam, the market was in this massive, completely unjustified bubble. Guided by his mentor, the brilliant investor and DMart founder Radhakishan Damani, Jhunjhunwala realized the surge was entirely artificial. Instead of getting caught up in the hype, they short-sold the overvalued market, essentially betting that the prices would inevitably crash. When the bubble finally burst, Jhunjhunwala walked away with one of the absolute biggest profits of his life. Section 4. The ultimate patience test. The power of holding and the cost of emotion. We've talked a lot about his aggressive risks, But perhaps the most crucial part of his overall strategy was his unwavering, almost superhuman patience. And this brilliantly illustrates that point. His investment in Titan. He bought into the company around 2002, snagging shares at an adjusted price of just 3 rupees. Over the years, the stock faced massive volatility. It surged, it dropped, it tested the nerves of everyday investors who kept rushing to cash out. But Jhunjhunwala held on because the company's core fundamentals simply hadn't changed. That 3 rupee investment eventually soared to a peak of 1,182 rupees, building a massive 4,000 to 5,000 core anchor for his entire portfolio. But, even the big bull made emotional missteps. Back in 2004, to appease his mother, he sold a chunk of his Crystal's shares. Actually, he sold them specifically to buy a property in Malabar Hills for 27 crores. He later sold that property for 48 crores. Sounds like a nice profit, right? Well, if he had just held those Crystal shares as equity, they would have been worth over 750 crores today, plus another 50 crores just in dividends. It's a slightly painful yet pretty funny reminder of the unmatched long-term power of equity over almost any other asset class. So how did he physically manage all this momentum and his long-term holdings day to day? He operated with this legendary 5-screen setup. Screens 1 and 2 were totally locked onto his active trading positions. Screen 3 was dedicated entirely to monitoring his long-term investments. Screen 4 was a continuous feed of Bloomberg and real-time financial news. And Screen 5? That was kept open for internet research and reading articles. He was literally constantly absorbing information. Section 5. The Big Bull's Playbook. Rules for Retail Investors. Let's synthesize everything we've learned so far into a concrete list of rules that you can apply. First, let's look at how he structured his firm, Rare Enterprises, which, by the way, was named by combining his name, Rakesh, and his wife's name, Rekha. Despite managing billions and holding massive stakes in giants like Titan, Tata Motors, and Star Health, the firm operates through only one single demat account. One. This just completely highlights his intense focus on privacy and concentration. He absolutely didn't want anyone tracking his moves or front-running his trades. So the crucial point is really baked right into these 3 foundational steps from his philosophy. Step 1, trade within your risk appetite. Seriously, don't borrow to trade. Step 2, detach emotionally from stocks. If your stop loss is hit, meaning the stock drops to your predetermined exit price, or if the fundamentals change, just get out without regret. And step 3, hold your winners patiently. Unless you have a really solid fundamental or technical reason to exit, you've got to let your winners run. Building on that, let's rapid fire his essential rules. Never, ever invest your emergency funds or take out loans to trade. Do not rely on blind tips. You always have to do your own independent research. Always stay optimistic about the market. You have to believe that over the long term, the index is going to go up. And finally, you absolutely must continuously learn from your mistakes. And that last point is vital. Learn from your own mistakes. The big bull wasn't perfect, not by a long shot. He had his share of bad trades, and he even faced controversies. Like, there was a prominent insider trading accusation by SEBI, the market regulator, that eventually resulted in a massive 35 crore settlement. But his golden rule was always to accept when he was wrong, take the financial hit, internalize the lesson, and adapt his strategy moving forward, without ever fighting the market. Rakesh Jhunjhunwala showed all of us that with relentless research, calculated risk, and ultimate patience, massive wealth is truly possible. So I want to leave you with this. Look at your own investments right now. Which rule from the Big Bull's playbook are you going to apply to your portfolio first? Think about it, take action, and keep learning. Thanks so much for joining me